Welcome back to the Deep Dive. We've got some interesting material here today, sent in by you, actually. It looks like an excerpt from a tax training ebook.
That's right. And it touches on quite a few areas of the Canadian tax system, but looking through it, there are some bits, especially around saving, that are laid out pretty clearly.
Exactly. So for this deep dive, we thought we'd really zero in on one specific thing, mentioned quite a bit in here. Registered retirement savings plans. You know, RRSPs.
Good plan. Our goal here is basically to unpack what this particular source material tells us about RSPs. Pull out the key details, the rules it mentions, what it says the implications are, so you get a solid picture based purely on this document.
Okay, sounds good. Let's dive right in then. Where does this thing first bring up RRSPs?
Let's see. It comes up under retirement income and deductions. The source groups RRSPs as one type of deferred income plan. It mentions them alongside RPPs and DPSPs.
Deferred income plan. That phrase kind of gives the game away, doesn't it?
Mm-hmm.
The core idea, according to this material, is that the money you contribute, well, it's deductible for figuring out your net income.
Yeah.
The source says contributed on a tax-free basis.
Exactly. And then the flip side, where the deferral really happens, is that when you eventually take money out, those withdrawals are fully taxable. That's the wording used here.
So tax break now, tax payment later. That's the deferral.
Precisely. And the text makes that explicit. It says, this whole setup results in the deferral of tax until the RRSP amount is withdrawn. Simple as that, according to this.
You know, there's also a neat little pronoun here about timing your contributions.
Oh, yeah.
It notes, the earlier during the year that an RRSP contribution is made, the better it is. Because, well, there's more time for the money to grow tax-free. It really highlights that compounding aspect.
Right, that tax-sheltered growth is a key part of the picture this document paints.
Good point. Okay, so we get the basic mechanism from the source. But how much can you actually put in? What limits or rules does this document lay out?
Well, it details how the deduction limit is calculated. It says it's based on your income from the previous year, your prior year earned income. The limit is the lower of two numbers, 18% of that prior year income, or a set annual dollar limit for the current year.
And it gives the dollar limit for 2023, doesn't it? It says here it was $30,780.
Correct. That's the number provided in this material for 2023. And contributions within that limit. The source classifies them as other deductions on your return.
What if you accidentally put in too much? Does it mention anything about penalties for over-contributing?
It does, yes. It states pretty clearly that there's a penalty. It's 1% per month on the amount you've over-contributed.
Ouch. 1% per month adds up.
It can, but the source also mentions a bit of a buffer. It says a $2,000 over-contribution is actually allowed without any penalty, so there's that specific allowance noted.
I remember seeing an example in here about someone named Ben. His employer put money into his RRSP. How did that work with the limits, according to this text?
Yeah. Yes, the employer contribution. That's a good catch from the examples. The source explains it's a taxable benefit to the employee, so to Ben in that case.
Okay, so it adds to your income initially.
Right. But crucially, that same amount is also included in your total RRSP contributions for the year. And it counts towards determining your deduction limit. So it's both income and part of your potential deduction based on how this source describes it.
Interesting duality there. Okay, so withdrawals are normally taxed. But this material also talks about a major exception, right? The home buyer's plan.
Yes, exactly. The HBP. It's outlined here as a specific way you can take funds out of your RRSP without paying tax on it immediately. But there are conditions.
What are the main conditions listed in this document?
Two key things, according to the source. First, the money has to be for buying or building a qualifying home. Second, you basically need to be a first-time home buyer, defined here as not owning a home in the previous 4 calendar years.
And how much can you pull out? Does it give a figure?
It does. This document states that a taxpayer and their spouse or common law partner can each take out up to $35,000.
$35K each.
Yeah.
Okay, so the money comes out tax-free for the home purchase, but it's not just free money forever, right? You have to pay it back.
That's correct. The source specifies repayment rules. It says repayments must be made in equal annual installments, and it's spread over a 15-year period.
15 years. And when do those payments have to start?
The material is quite specific. Repayments begin in the second tax year after the year you took the money out. Not immediately, but starting year 2.
And what if you don't make those repayments on schedule?
Then the tax deferral ends for that portion. The source says, to the extent that repayments are not made, the amounts will be included in your income for tax purposes for that year. so you end up paying tax on the missed repayment amount.
Got it. There was one other little HBP rule mentioned, something about timing contributions right before you withdraw.
Oh, right. Yes. Very important detail from this text. It says, no deduction will be permitted for RRSP contributions made less than 90 days before its withdrawal under the plan.
Ah, so you can't just quickly top it up and pull it right back out under the HBP to get an extra deduction.
Seems that's the rule this source is highlighting, yeah. Prevents that kind of immediate cycling.
Okay. This material also seems to touch on RRSPs in other sort of major life situations.
Yeah.
Like, what does it say happens if someone passes away or if they move out of Canada?
It uses examples for those. For death, there's the Marley example. The source indicates the RRSP's value at the time of death gets included in the deceased person's income for their final tax year.
So it becomes taxable then.
Yes, and in that specific example, it also mentions the RRSP asset itself went to the surviving husband. Now, the source doesn't really go into detail about general spousal rollover rules, just presents this outcome in the example.
Okay, just what's in the example? And what about moving country? Changing residency?
There's the Lorna example for that. According to this document, if you become a non-resident, you essentially get a choice about your RRSP.
A choice, like what?
Option 1, you can collapse the RRSP. If you do that, the source says the full value is taxed on your Canadian return for the period right up until you left.
Okay, so you pay the tax then and there. What's option 2?
Option 2, according to this source, is you can just choose to keep holding the RRSP. And if you do that, it states there are no tax consequences at the time of her departure from Canada. The tax implication would presumably come later, perhaps when funds are withdrawn, but no immediate hit upon leaving.
Interesting choice presented there. Okay, let's try and pull it all together then. Based only on this source material we've been digging into, what are the really key takeaways about RSPs?
Well, I think the source clearly lays out the core mechanics. You get a tax deduction for contributing up to certain limits with penalties if you go too far over.
Right. And the money inside grows tax deferred.
Exactly, tax deferred growth. And then generally, withdrawals are fully taxed when you take the money out later on.
But we also saw that big exception details in the text, the home buyer's plan, with its specific rules about who qualifies, how much you can take, and that 15-year repayment schedule.
Definitely a key exception highlighted. Plus, the examples show how this source sees RRSPs interacting with major life events like death, where the value becomes income, or moving country, where you have that choice to collapse or hold.
So really understanding these specific details, just as they're presented in this document, gives you a solid handle on how these rules are supposed to work, according to the source anyway, and how they might play out in different scenarios you might encounter.
Absolutely. I think this deep dive shows that, as presented here, RRSPs are framed as a powerful tax deferral tool. But you really need to grasp the specific rules this source lays out, contribution limits, the HBP mechanics, what happens if you leave Canada to navigate it effectively based on this information.
Yeah, exactly. And, thinking about those specifics, like that choice this source presents if you become a non-resident, or that very precise 15-year clock for HBP repayments, how might knowing those particular rules, as written here, shape your own longer-term thinking about savings or buying that first home or even planning potential international moves down the road? It definitely gives you some concrete points to mull over based on this material.
It certainly does. Those details matter for planning.
Well, thank you so much for sending this source material in. It was genuinely fascinating to explore the RRSP details as laid out right here in the text. That was a really focused deep dive.
My pleasure. Always interesting to see how different sources explain these things.
We'll be back again soon with another deep dive into listener-provided sources.